All right. Well, why don't we go ahead and get started? And we'll have this recording so anyone who's joining a little bit late will be able to catch up on everything. So first, everyone, thanks for joining tonight. This is going to be a really cool, informative session. We've got Jesse Stein, who is the Chief Investment Officer at Homeshares, and they specialize in an area of the real estate asset class that is newer and really exciting and has a lot of unique kind of advantages to diversify any sort of real estate portfolio. So, without giving it away or anything too much, Jesse, thank you for being here and for sharing all this information and opportunities with us. So I'll let you take it over, and everyone certainly, if you have questions that come up during the presentation portion, please feel free. You can put your virtual hand up, or if you want to put something into the chat. But we'll have plenty of time for a really good Q&A at the end as well. So, Jesse, thank you.
Thanks, Jordan. And hey, everyone, thanks for joining us on this Thursday evening. Appreciate you spending your time here. We've titled this presentation The Hidden Real Estate Asset Class. But what you'll find out is that that asset class is actually the biggest subsector of real estate and one that everyone is likely very familiar with. Just some background on myself. I have about 20 years in the real estate investment space, primarily creating innovative investment products. I've formed REITs, REIT indexes, real estate derivatives. I've built trading platforms. I've been involved with Nada for about 4.5 years. I was formerly the head of real estate at Republic, and while I was there, I was introduced to the Nada team, and we entered into a joint venture to create a series of funds around home equity. I also spent some time on the NADA board, and I joined full time this year in March as the chief investment officer at the same time that we formed our new fund, U.S. Home Equity Fund. NADA has been in business for about 6 years. The founder, John Green, has a deep background in mortgage finance. It was initially started as a mortgage and home equity product company, and we've been involved in the home equity sector specifically for about 4 years. Not as the parent company, Homeshares is the brand for our investment platform, and not as a venture-backed company. Below, you can see some of the institutions that have invested with us. Quick disclaimer, we are raising capital for our U.S. Home Equity Fund. It is a Reg D offering available to accredited investors, and let's not take the time to read everything on this page. First, I want to start with an introduction of home equity agreements, which, like I said before, is related to the home equity of residential real estate, which is the largest subsector. It's $34 trillion in the US. And people are often surprised to know that that's almost 3 times the entire residential debt market. And that is because, as we know, home prices continue to rise and expand. Yet, a lot of people who have owned homes for a long period of time have significant equity that they're unable to tap. It's the largest asset that they have. A lot of their personal net worth is tied up in that asset, but it's completely illiquid for them. The home equity agreement solves this problem. What it does is it allows homeowners to unlock that equity that they have in the home. And the way that it's structured is that it's a 10-year contract with a lien where a homeowner receives cash payment today in exchange for a share of their future home's value. Now, this is different than a loan in that there's no interest rate. And that is really what makes it attractive to homeowners. A homeowner does not necessarily need to affect their credit. They don't have monthly payments. Oftentimes, you have homeowners who have looked into other type of financing products like a HELOC, but don't necessarily have the income necessary to qualify for those. And this is a product that fits them perfectly. Think about older homeowners, 50 something, 60 something, 70 something. They've owned their home for decades. They've built up a tremendous amount of equity. Their income levels haven't necessarily risen at the same pace as the equity within their homes. And this is a way for them to take out some of that equity. relatively new product. It's actually been around for 20 years. There was a company, Unison, that started these type of products in 2006, but this product has really taken off and has become a lot more institutional over the last 2 or 3 years. And there's a couple reasons for that. In today's mar- market, you have much higher interest rates today than you had a few years back. So you have a lot of homeowners who are stuck with 3%, 4% mortgages. They have no way of refinancing or cashing out their refinance because no one's going to refinance at 7% if they have a pull out equity through a refinance for something that has been around for a couple of years. There's also been an asset-backed securitization market that has developed for home equity agreements over the last couple of years, and billions of dollars of institutional capital have started paying attention to this asset class. And I'll get into the structure of why they're like the risk reward that this specific asset type creates based on the downside protection based on the structure. So here's an example of how a home equity agreement works and how that downside protection, is structured into this type of agreement where the homeowner wants to pull out $100,000 of cash. So we invest $100,000. Now, obviously, that's 10% of the home's value. But our structure, we use an exchange rate of 1.85 times our investment. So day one, we are collateralized with $185,000 of home value. So we're protected in the same way that a perf is, whereas over time, as that home increases in value or even doesn't increase in value, the amount that needs to be repaid back to us is based on that exchange rate in addition to home price appreciation. Now, I just want to caveat that by saying that there is an annualized max that a homeowner would have to pay, and that's 19.9%. But if you see the examples on the bottom right here, if that $1 million home after 5 years has appreciated by 3%, it's now worth 1.16 million. So we're getting paid 214,000. So we've received the 16% return. Increase in value at all, dollars of collateral, which results in a 13% return. And that's really what has driven a lot of the interest in this asset class is that we don't necessarily need the market to boom. We don't need the market to even go up for us to generate pretty pretty nice returns on the real estate side. Taking out a home equity agreement where there's really three categories of homeowners that we work with, and you proceed for different aspects. First is home improvement. We have a lot of partnerships with home improvement companies, solar as one example, where you have these solar companies or ADU company, pool company who they're able to sell their product to a homeowner, but the homeowner may not necessarily have the capital necessary up front. So what these type of companies do is they bring that homeowner to us where we can provide them with capital for them to use for these home improvements. Obviously, we love that as a use of proceeds because those home improvements, in most cases will increase the value of the home. Um, but we're almost agnostic as far as what the capital is used for. We have a lot of client relief to pay off, whether it's personal debt or any other types of debt related to their home. It gives them a better credit score by doing so and potentially allows them to refinance our home equity agreement into a different type of product. And then there's quality of life. We have a lot of retirees who, have built up significant equity in their home. Again, their income may not have kept pace with that growth, and they want to pull out some of that equity and use it for, a wedding, a vacation, their kids' college. There's a lot of things that people can do with the home equity that they've built up. Another really interesting aspect of this investment is that it's passive in two ways. Now, from an investor's perspective, of course, there's a lot of ways you can passively invest in real estate. Actively be buying a home and managing the tenant and managing the property and dealing with maintenance and home improvement. And very few people want to deal with that, right? Other types of passive investment would be investing in a fund or a real estate syndication or REIT. There's a lot of ways for an investor to invest passively. Now, there's a second layer of passiveness in this asset, in that the asset management, the property management that you typically see in a real estate syndication or a fund, it's absent here because the homeowner is the built-in property manager. And what we like about that is that typically homeowners are going to take a lot better care of a property than a tenant will. They're also always going to occupy that. We don't need to deal with vacancies or turnover, or tenants not paying their rent. The homeowner deals with day-to-day maintenance. Homeowner deals with capital improvements, paying insurance, real estate. So for us, we're making a passive investment on our side, and we're really just letting the market and the structure of this product do the work to generate returns. And you don't have that typical execution risk that you have in other types of real estate investments. So even though we are investing passively, we have a very strict underwriting process, very similar to what you'd see at a mortgage company. And a lot of the criteria is similar. We're very much concerned with combined lean to value. We don't call it loan to value because our product is not technically a loan. On average, we're coming in at about 50% lean to value. That's after the first mortgage, if one exists, together with our investment. So that means there's still 50% of equity on average in the properties that we invest in. And because of that, a property can decline significantly before our investment is impaired. We do things like making sure that the income is there to pay for the first mortgage. We make sure we do credit checks, we do title checks, we do property inspections, all of the things that a mortgage company would do. Not as concerned with the homeowner's ability to be able to pay us on a monthly basis because there is no interest expense. We only care is there going to be enough equity left in that home when it's time to repay our investment. And that would occur on the sale of the home or refinance of the first mortgage. And being at that 50% lean to value, day one, there's a lot of equity on top of where we're sitting. And we do expect the equity to continue to grow as home prices appreciate, as well as that first mortgage principal balance gets paid down over time. I put this slide in twice, so I'm going to skip this one right now and jump into more detail on the fund. And the reason we started U.S. Home Equity Fund in March is really because of what we saw in the industry about the asset class becoming more institutional. We saw investors who were participating in this securitization market. They wanted to see large, diversified pools of these assets, with a geographic diversification and the opportunity of securitizing, because through securitization, you can really generate returns and deliver capital back to investors. So just to summarize why we are really excited about home equity agreements as an investment opportunity, it's the downside protection. Based on that exchange rate, that $1 million home would have to depreciate by 45% before our investment is impaired. And that doesn't really exist other type of real estate equity investment. That is the type of protection that you see with lower leverage debt. Again, we like investing in owner-occupied properties because those owners are going to take good care of those properties. Those owners are going to try and increase the value of those properties. And for us, it creates that passive investment model. And even with those very defensive, passive benefits around the protection and where we sit in the property, we're not necessarily giving up the upside. The 14 to 17% annualized returns that we're projecting, very much in line with other types of real estate equity investments. I just want to keep hitting on this downside protection because that is really the whole key to this entire product. And here's, that same example one more time, that $1 million home, where we have that $185,000 value or collateral day one based on the 1.85 exchange rate on our $100,000 investment. Now, let's say that home declines in value by 45%. So that would be an even worse decline than what we saw in 2006, 2007, 2008. Okay, the entire housing market crashes, or, in this specific market or this home's value, it basically crashed. We haven't lost any money. Our HEA is still worth $101,000. So it's really special in that the downside protection that this structure creates without necessarily giving up that upside is really why we think this is such a special investment type. Sorry, I'm going backwards. Okay, this is an important slide here. I've talked about home price appreciation, which is the that vertical column all the way on the left, going from -5 to 6. That is one factor which dictates the returns that we generate on the contract. The other variable is when we get repaid, when the contract gets repaid. The typical repayment for a home equity agreement is between years 4 and 6. There's about 10 to 15% organic repayment each year, from people selling their homes, from people refinancing, from people coming into money one way or another, and then repaying us our investment. And as you can see, the quicker someone repays us, the better our annualized return. So we're almost guaranteed a 20% return if someone repays us within that first 3 years. And then from that point forward, home price appreciation starts to become a more important variable. I just want to touch on those top few rows where you have an annualized depreciation of home values every single year for each of those 10 years. As you can see, again, we're not losing money in any of those scenarios. And just that yellow box, that's our base assumption, right? We're assuming that over the next 5, 7 years, home prices appreciates by 3 to 5%. And again, the average repayment is about 5 years. Here are some high-level terms for U.S. Home Equity Fund. It's a Delaware limited partnership, so you have pass-through of income. General partner is an affiliate of NADA. We're raising up to 100 million. The minimum investment today is 25,000. This is a 5-year fund. We do have the option to extend for an additional 2 years, but our goal is really to provide liquidity to investors well before then, through various exit strategies, which I'll get into in a couple of slides. There's a 1.5% management fee, and then a carried interest of 15% above a 10% preferred return. So after we build our portfolio of home equity agreements, we're going to start looking towards different exit scenarios. Again, there is that organic repayment of contracts, 12 to 15% industry-wide, typically get repaid each year. So over the 5-year period of the fund, a significant amount of contracts are just going to get repaid to us as homes sell, as homes are refinanced. But what we're really focused on is an asset-backed securitization, and there's a couple ways for us to participate in that. One, we could build a portfolio and securitize that portfolio ourselves, or two, we could partner with another asset manager and contribute our assets into a pool and participate in the securitization through that type of structure. In either of those, the result would be a significant amount of investor capital coming back to the fund, which would then get distributed back to investors. So I'll go into examples in a bit, but there could be a scenario where you make an investment today, and within 2 years, you have 100% of your capital repaid through one of these securitizations. These type of assets, there's a secondary market, similar to how there's a secondary market for loans. So we will have the ability to dispose of our portfolio to other asset managers who are investing in this asset class. And then there's also the potential that we could take this portfolio public and become the first traded REIT focused on home equity agreements. As I mentioned, we launched this fund in March, though we still have a sizable portfolio of home equity agreements. This is at the end of last quarter. We had 137 agreements. The majority of those were rolled into the fund from previous funds that we managed. And as of June 30th, there's about 12 million of asset value. You could see we have 5 million of liabilities. We do have a credit facility with an asset management firm, Kawa, that we can draw on up to 25 million, though it is restricted to 65% of total asset value, and I don't think we would even draw up to that point. So there's about 7 million of equity in the fund as of the end of last quarter, and the portfolio is spread out across 9 different states. Just some more portfolio characteristics. This is both for the fund as well as what we've done previously. Nada, as a company, have originated over 250 home equity agreements. On average, over the past year, these have been almost $100,000, and the average house value is just north of 500,000. Typically ranges from 300,000 to $1 million. Our customers' average credit score is about 650, and you can see that most of our customers have low interest first mortgages. Those first mortgages average around 36% loan to value. And again, we come in, above that to, in from say 36 to 51% is where we are on average. Um, to date, we've had about 40 of those 250 plus home equity agreements go full cycle, meaning they've been originated and then they've been repaid. That's part of that 10 to 15% annualized repayments. And those full cycle investments have generated on average a 16% IRR. This is the team. You could see me on the right. Torstein is our CEO, formerly founder and CEO of CrowdStreet. He's been in the real estate investment space for 20 plus years. John Green, our founder, deep background in mortgage and fintech. Sundance Brennan, our head of originations, has originated billions of dollars of different types of mortgage products. And Justin, our head of capital markets, has 15 years in institutional capital raising. In addition to the 5 people here, we have another dozen or so spread out. Our corporate headquarters are in Dallas, but we also have people in Austin and New York City. If you are interested in investing, you can go to our website, homeshares.co. All of the information about the fund is there. It even gets down into asset level detail. You can see different type of documents. We have a pitch deck that's similar to this presentation, the PPM, partnership agreement, and you can invest directly on the website. You can pay by ACH up to $100,000. A wire transfer can be sent for anything beyond that. And then after you invest, you can use our platform to check in on your investment and see how it's doing. We do quarterly NAV updates. We also work with a third-party administrator, NAV consultant, that provides statements and calculates that NAV on our behalf. But you can utilize our platform to see all of the information, the documents related to your investment, etc. Here's our contact info. Again, the website. And at this point, I think we can move on to question and answer.
Yeah, that was fantastic, Jesse. Thanks for that kind of overview and I think a very clear picture of like what the investment is and advantages and things like that. Um, Ravish has a question, then I have a couple as well. There's, they're asking, is the 10-year term fixed for HEA or are there shorter term HEAs like 5 years?
We've done shorter term for investment properties previously, but our standardized contract is 10 years, and I think every owner occupied property is 10 years.
And in terms of like holding period for the investor, is that kind of similarly correlate?
Well, our fund is a shorter time period, and that's why we're really focused on liquidity events, n not even at the 5 year term, but well before then, within the first 2 or 3 years. Similar to a company that invests in debt with longer term debt than the actual fund. And because there is a secondary market and the securitization market, it will give us the ability to exit these assets before the term before the term is up on the 10 years. And just to follow on the question about the 10 years. So a lot of people ask, well, what happens at the end of 10 years? So um, similar to a mortgage that has a balloon payment, in most cases, it will be refinanced either through us or through another company. Obviously, we're not going to force someone to sell their home. We do have the right. We have a lien. If we had to, we would have the right to foreclose. We certainly do not want to do that. And it's much more likely that we would adjust their HEA, put them into a new HEA, or help them refinance into a different type of financing facility in order to pay us back.
That makes sense. Um, Khalid has a question. Is there a drip option?
We don't have a formal drip. But what I would expect is that as we make distributions, and these distributions would likely be in bulk. This is not the type of fund where we're saying, hey, this is a 7% annualized dividend that is going to be paid out quarterly. We're going to be making very large, chunky distributions. And although we don't have a distribution reinvestment program, I would expect us to have at whatever point in time we make those distributions, other investment opportunities so that if you did want to roll your proceeds back into another fund that has the same strategy, it would be an option that would be available.
Okay. Ravish has another question. Is the 1.85% exchange rate fixed? And how is that split with investors?
That's the base exchange rate. It does not go lower than that. We have increased it in certain cases based on various underwriting criteria to 195 to 2.0. Um, investors investors don't split that at all. So an investor is not investing in any single home equity agreement or asset. Investors are investing in the fund which owns a pool of these home equity investments. So there's no split specifically related to that exchange rate. That exchange rate is really what provides us with the over collateralization and ultimately helps us build those returns over time.
Awesome. Um, how you kind of mentioned this a little bit, but just to kind of explicitly discuss it, obviously the real estate market is, if we go back to like COVID to now, like changed a lot as rates have changed and prices seem to be staying, at a certain level. How do those changes in interest rates, et cetera, affect the fund? I know that kind of seems to be a nice part of where it's a little bit insulated, but maybe you can describe that a little more in detail, like the nuts and bolts of that.
Yeah, look, there's a lot of uncertainty in the real estate market, and a lot of real estate investments over the past few years have not performed very well because of that rise in real estate and rise in interest rates. Um, you know, you've seen commercial real estate values decline, really just because cap rates went up. So this is a less interest rate sensitive investment type. Again, for the short term we're not that concerned with home price appreciation and how interest rates impact that home price appreciation. Of course, we'd like for the home values to go up, but even if there was a short-term decline, it doesn't necessarily hurt us all that bad in the short term. Long term, we do expect home values to go up. It's just a question of, at what pace. Um, but I think it's that uncertainty of the market today that makes this type of investment even more interesting, the defensive aspect of it, and the fact that there should be less volatility with our returns just based on how these are structured. As far as interest rates specifically, it's an interesting dynamic because if interest rates were to decline for whatever reason, um, it it would allow a lot of our current clients to refinance who wouldn't necessarily refinance at 7, but they'd be very happy to at 4 or 5. And that would help drive our returns because more contracts would get repaid earlier. Now, it would be more difficult for us to originate these because we would be competing with refinances. However, based on today's demographic of homeowners, first of all, it's such a huge market, but there's also so many older homeowners that just don't have the income to support a HELOC or additional financing because they're retired or they just don't want that extra burden mentally, right, of increased monthly costs. So even if someone, necessarily could refinance at a lower rate, this might still be a more attractive product because there are no monthly payments.
Yeah, that makes a lot of sense. Kind of piggybacking off of that a little bit, how are you guys sourcing these HEAs at the individual level? Is that something like through a broker almost, or do you guys have an arm that kind of is putting that out there and vetting potential people who are interested?
Well, we originate everything in-house, and that's one of the advantages we have, and it is in that as the portfolio manager, I can really pick and choose where I want to invest and which assets I want to invest in. Um, we have a whole team, but a lot of the leads are driven through partnerships. Again, we have a bunch of partnerships in the home improvement space where they're driving traffic to us for homeowners that need capital for home improvements. We also have partnerships with various mortgage companies, mortgage brokers, where if they're approached by a homeowner and their existing product doesn't necessarily fit with them, but a home equity agreement might, they pass that customer along to us. So I would say it's 85, 90% referral and partnership driven. And then, we do a little bit of marketing that drives, interest direct to us.
Yeah, I think that's a huge advantage, you guys originating everything in-house. Um, Khalid has another question. What type of headwinds, challenges do you anticipate in this specific asset market over the next 5 years? Great question.
It's macro. I'm not necessarily expecting anything, but the same macro risks that exist, at the very high level, like a big housing crash for whatever reason would obviously impact us. Home prices would have to decline pretty significantly for us to lose money. But if you did have a 30-40% decline, it would take some time for us to catch back up, over the next few years in order to really hit the returns that we would want to achieve. So it's that housing crash that's the real, risk to us.
And with that, is there any sort of like regulatory concerns or issues or anything like that investors should be aware of or anything like being talked about, I guess?
Uh, so So all of these products are regulated at the state level, not at the federal level, the same way that mortgages are.
Mhm.
And because it's a relatively new product, the regulatory aspects of it haven't necessarily been 100% defined.
Mhm.
But we have mortgage licenses in every state we originate, 16 states. We have licenses in each of those states. So regardless of how a state would choose to classify this, we're covered under our licenses. And that's a decision we made very early on. So there's not really risk to us as far as that goes. And the regulations are to homeowners. If you remember, there's that 20% annualized cap. That's a state-based usury law. So we're already following all of the rules associated with this type of product, even though it isn't specifically defined in the regulations.
Gotcha. Another question came in a private message. Are there any tax advantages for these types or classes of investments?
You don't have the tax advantage that you might see in a direct real estate investment where net losses pass through and you receive a K1 with a negative income, and you get to use that to offset. This is a Delaware partnership, so everything is passed through, but there's no depreciation. So you're not going to see a big net loss in order to offset income. Just keep in mind that net loss is deferred and it's not, you'll have to make it up in the future. But a lot of people, I understand, invest in real estate for that purpose. So, I just want to make it clear that we don't have that. One, semi-advantage is that almost all of the returns are going to be capital gains rather than ordinary income. Now, it would be ordinary income if someone repays us within a year, it would be a short-term capital gain. But because these are equity investments, as a contract is repaid after 12 months, it's a capital gain, and that capital gain gets passed through to investors. So that is, advantageous to being delivered ordinary income.
Okay. And I see we have a live question here, Ravish.
Hey guys, can you hear me okay?
Yes.
Awesome. Yeah, no, thank you for the talk. This is great presentation. I knew nothing about this actually. So thank you for arranging, Jordan, and thanks for doing it, Jesse. Rather than just texting questions back and forth, I do have a few questions, if that's okay with you guys.
Of course.
Yeah, shoot.
Is the 1.5% management fee, are there any other fees besides that, or is that pretty much all we're looking at for the management fees?
There's a 1.5% base, and then there's the 15% carried interest above a 10% preferred return. The origination side of our business also gets fees. They get paid from the homeowner, and then they also get paid an acquisition fee from the fund of 3 to 5%.
So could you dumb it down a little bit for the hurdle rate? I have not heard that term before, the carried interest and the hurdle rate, please.
Sure. So the 15% carried interest over 10% means that any returns that the fund generates over 10%, us as the fund manager would share in 15% of that. So if we were to, say, deliver a 16% return gross to investors, right? That would be 6% over the 10% preferred times 15%. So we would get an additional 90 basis point fee.
Got it. Okay.
And just so it's clear, the 14 to 17% annualized IRR that we're projecting, that is net of fees.
Got it. Good to know. Okay. And then are the annual cost limits, are they different according to different states? The ACLs, I think one of your slides had ACL of 19 some percent.
Yeah, that is. I think that is the lowest of the limits. And I think we apply that to all of our contracts. There are some states that I believe have higher limits.
Got it. Okay. And are the distributions on a quarterly basis, or how does that work?
No, they're not predefined in advance, and they're going to be very bulky. So, for example, our strategy is to enter into a securitization transaction at some point in 2026. And in that instance, we would return a significant amount of capital to investors, but we probably wouldn't have a distribution before then. And then from that point forward, there may be a gap until the next distribution because the distribution would be derived from us selling assets in bulk. So it's not a very stable income type product. It's more of a growth product where we're looking to deliver, returns over, the 3 to 5 year period, the hold period, but not necessarily pay out, cash flow every quarter.
Got it. So even though the term is for 10 years, on an average 3 to 5 years is how long you have seen in your experience?
Yeah, well, we're gonna have a bunch of contracts that just repay over that 5 years, from home sales or refinances, and then these capital markets type transactions, the securitization, a bulk sale, those can occur, well before the end of the term of the contract. The same way you could sell a bond or a loan before it matures.
Okay. And how many of these deals you guys have, say, I guess on an average
We've done 250 to date. I would, I don't have that number offhand. I would say we did about 100 last year, and we've probably done, I don't know, 75 this year. I don't have the exact number, but
Sure, sure. That's helpful to know, though. Thank you so much. Really appreciate the talk.
all right, thank you.
Thanks.
Yeah, those are fantastic questions. Thanks for asking. As we kind of reach our wrap up time, uh, quick question. Is there a minimum investment and how much is that?
The minimum is 25,000.
Okay.
And you can do that directly on our site. If you're not comfortable investing online, we can work with you and do it on a more manual type basis.
Okay. Another good tax related question, but are the tax documents consolidated from the various states when they're provided to investors?
They are, yes. Although we as the fund may incur we may generate income in various states. We'll file the necessary returns in each state, so investors don't need to. Investors may need to file a return, obviously, in the state that they reside in, but they should only have to file the federal return. They should only have to include the federal K-1 in their returns.
Got it. No, thank you so much, Jesse. This was an incredibly informative talk and really interesting learning about this asset class. You have all your information there, so certainly everyone, if you have questions, feel free to reach out, and I'll be sending a recording later of this as well. Um, Jesse, thank you for your time. Everyone who came, thank you for your time as well. And I hope you all have a great night.
Yeah, thank you, everyone. Appreciate your time.
All right, night, everyone.